And that's one of the challenges, is an old way of diversifying, in my experience, quite often, or in many cases recently, hasn't produced the results people thought or hoped for. And I think it's reasonable to think that may continue to be the case, that trend. And that's why I think it's so important to at least become familiar with some of these other options that, in my opinion, do provide a much more predictable path, higher probability of success. So here we have 14 different financial options, right? Most people are familiar with stock, individual stocks, stock bond fund. Again, think of that house, foundation, wall, roof. Interesting thing is most of your stocks and bonds here, right? Especially if they're individual, they're all in the middle or the top, right? What do you have in the bottom? What do you have as your foundation? Good question. You should have a good answer. Your advisor should have a good answer, right? Again, you'll notice that they're typically not investments, right? Some combination of insurance, bank products. So learning about financial options that can provide flexibility, growth, varying levels of downside protection. How many of you are familiar with structured notes? One, about 20. Congratulations, you're ahead of the percentages. Quite often it's not surprising if it's none. But you're all going to know a little bit more about it, right? Very important. I've been using them for about 6 years. And we have different strategies we call with our defined risk, right? So you can change the risk reward. So typically in the investment world, it's that red line. You have unlimited upside. Unfortunately, that comes with what? Unlimited downside. So what is defined risk? It's changing that risk return outlook, that risk return scenario. So here's an example of a structured note where typically there's always a trade-off. Again, it's not a perfect product, but now that blue line, you're limited to the growth. You're not going to make more than that. So if that's right for you, you need to be okay with understanding, hey, if things are great, I'm not going to go up as much, right? But if the markets are down, I'll go down less. Depending on the structure or the term, you may even make money when the markets are going down. How cool would that be? How many of you know how to do that? You will after this, if you take good notes. So, what are structured notes? It's a sophisticated investment instrument. It's typically only offered through advisors, issued by investment banks. Not right for everyone. All different sort of structures and reasons, but typically it's for income or for growth. And here's an example. And so I've been using these for over 6 years, and what got me into it is the idea of not having to rely on the market to continue to go up to make good progress each year. Number one. Number two, how cool would it be to earn 6, 7, 8% even when the market's down 15 or 20%? Well, a certain type of note can deliver that for you. So what you'll see here is down market, but again, there's no free lunch, so these aren't risk-free. Most of the notes that I see as the most attractive, you're protected down to a 30% decline. So if the indexes go down to a 70% level, you're going to have a potential substantial loss. So for some people, this isn't right. But I always say, another good question, people say, that's too risky, or that's not good. Like, compared to what? What are you doing now? How do we know, right? So again, what would be a really great scenario is you have it go down, but it doesn't go down below that 70%. And so these products have really benefited this year from an increased interest rates, increased interest rate environment, and they also benefit from when stock market volatility goes up. So really cool, like people don't like, it's not fun when the market goes down, but for new money, it typically is much more attractive. You can see here, this is the average interest rate on the notes that we use every month or used. And, from in 2021, the average a little bit less than 8%. You could see it ticked up in February this year, ticked up over 11%, right? So again, They benefit from rising rates, and they benefit from market volatility. Do stocks benefit from those two things, typically? Interesting. Might be a good diversifier to mix in, to have for a portion, right? Thank you for watching. I hope you found the information helpful. If you'd like to talk about potentially having me as your advisor, use the link below or visit our website to request a no-cost, no-obligation conversation.